Okay, good morning, ladies and gentlemen. Welcome to the Ryanair Q1 results press conference. I'm joined this morning by Neil Soren, the Group CFO. And we have on our Ryanair.com website placed this morning's the press release, the Q&A, and also the full detail of the Q1 numbers. We're pleased to report a Q1 profit of 663 million this morning. Primarily that was due to a very strong Easter period. There was a second UK bank holiday in May, but primarily it's because of a very weak prior year comparisons. The Q1 of last year was heavily distorted by the Russian invasion of Ukraine, which started in February 2022, collapsed Easter, and we had to engage in very aggressive price stimulation in Q1 of last year. So the prior year comps were badly affected by Ukraine, whereas thankfully this year the Q1 had no such adverse effects, and we've enjoyed a strong quarter. Traffic in the quarter rose 11% to 50.4 million. Revenue per passenger was up in the quarter by 27%. At the quarter end, we had 119 game changers in the fleet. The total fleet was just under 560 aircraft. We opened 3 new bases in the quarter and 190 new routes. The 3 new bases are in Belfast, Lanzarote and Tenerife. In fuel hedging, we are 75% covered for this fiscal year to March 24 at about $89 a barrel, slightly above current spot prices. We've also increased our hedging for FY25 to 27% at about $74 a barrel, slightly below current spot prices. At the quarter end, the balance sheet has strengthened. We had net cash of just under €1 billion. However, we need 750 million of that to repay bond debt in August. And both Fitch and S&P have increased our rating from BBB to BBB+. I think the most significant development in the quarter, though, was the 300 Boeing MAX 10 order in May, which will allow us both to renew our fleet and launch Ryanair on a decade of growth that will take us out to about 300 million passengers by 2034. Just to touch on a couple of other highlights, we continue to benefit from EU capacity constraints. Eurocontrol figures recently released suggest that short-haul, the European market, is running at about 93% of its pre-COVID capacity through the summer of 2023. The market continues to be characterised by higher oil prices, aircraft shortages that won't be resolved because of OEM delivery delays. And we're also seeing the benefit, certainly in short-haul Europe this summer, of a very strong US inbound traffic and the reopening of Asia. I think during Q1, traffic has been up 11% and average fares slightly distortedly with a weak prior year comp are up about 40%. Q2, we expect traffic to be up probably about another 11%, but the fares will be notably weaker in Q2. Q2 last year was very strong. We recorded a profit of 170 million in Q1, but as a result of that price stimulation, we had a very strong snap-up in Q2, where we reported a profit of 1.4 billion. Because we have a much stronger prior year comp in Q2, our performance in Q2 will not be as strong as it was in Q1. We do expect fares, though, to continue to be above the prior year comps, but we think it'll be a low double-digit figure. The EU airlines that continue to consolidate. We're seeing ITA and TAP have already begun consolidation talks. Lufthansa looks like it will take over ITA, and who knows who will take over TAP. But within that marketplace where we have seen consolidation and capacity constraint, Ryanair's unit cost advantage is widening materially. In terms of the fleet, as I said, we had 119 aircraft at the end of the quarter. We expect that to rise to 124 aircraft at the end of July. We are now confident that we'll get all those aircraft by the end of July. The Boeing delivery days won't, thankfully, stretch into August. We expect to take 86 more game-changer aircraft over the next 2 summers, so summer 24 and summer 25. But the big news is the new the 300 Boeing MAX 10 aircraft order. These aircraft will deliver to us between 2027 and 2033. They offer us 20% more seats, 228 seats as against 189 on the NGs. but they burn about 20% less fuel, 20% less CO2 emissions, and they're 50% quieter. So not alone are they going to dramatically lower our operating costs, but they're also going to be a significantly more environmentally efficient than our existing fleet. And we think this order not alone sets Ryanair on a path for a decade of growth, but also will materially widen our cost advantage over all other airlines. In terms of the balance sheet, briefly, as I said, we closed the quarter with just under $1 billion in cash. We have been upgraded to BBB plus by both Fitch's and Standard & Poor's, and the balance sheet will continue to be the strongest in the industry. In terms of outlook, we're stepping back our traffic growth slightly this morning. We're moving it back from 185 million passengers for the full year to about 183.5 million. That's essentially due to the Boeing delivery delays both this spring. It also looks like we're going to suffer delivery delays with Boeing in the autumn of 2023. We expect to take delivery of 51 aircraft between September and April of 24. It now looks like the last of those aircraft will be delayed into May, possibly June of 2024, and we're working closely with Boeing and Spirit in Wichita to try to ensure that we don't suffer any further delivery delays. So traffic will be slightly lower than we had originally anticipated. The cost gap continues to widen between us and our competitors. Our ex-fuel cost, though, for the rest of the year will be slightly up due to the Boeing delivery delays, the full year of pay restoration, or full cost of pay restoration, and the start of the pay increases. Q2 bookings are strong. We expect to be traffic up about 11%, similar to as they were in Q1, but the pricing will be materially softer. In fact, we've noticed in recent weeks, close-in bookings as we get closer to the day of travel in both June and July have been a little bit softer than they had been in Q1. And the Q2 prior year comps are much stronger than they were in Q1 next year. So we expect to see a strong summer. The biggest irritant we have at the moment continues to be air traffic control, delays and strikes. So far this year, we've suffered 60 days of French air traffic control strikes. In May, we submitted a petition signed by 1.1 million of our very fed-up customers to Ursula von der Leyen and the European Commission, calling on them to protect overflights. It is, to my mind, unacceptable that the French authorities continue to use their minimum service legislation to protect long-haul and local domestic flights, while disproportionately cancelling overflights over France. This must end. We operate in a single European marketplace. We're calling on Ursula von der Leyen and the Commission to take some action to protect overflights, protect air travel, the single market for air travel across Europe. And if the French want to go on strike, which is their right, and we recognise that right, protect overflights, cancel the French domestic flights. With that, Neil, I'm going to hand it over to you to take us through the slide presentation.
Thank you very much, Michael, and good morning, everybody. Ryanair has the lowest fares and lowest costs of any airline in Europe. We're number one for traffic with 183.5 million this year, a 9% increase on the prior year, and just over 120% of pre-COVID capacity. We've got the industry-leading on-time performance and reliability, and have invested heavily in resilience this summer again. Sustainalytics have ranked us the number one airline in Europe for ESG, and our 300 aircraft order, the MAX 10s, will see us grow for the next decades to 2034. This, of course, is underpinned by a very strong balance sheet and low unit costs, which make us the long-term winner in our sector. We've got 91 bases and we're operating our largest schedule ever this summer. We've got a platform of growth, as you can see, which will enable us to grow to 225 million passengers thanks to the game changer order by FY26, and now sustainable growth to 300 million passengers by FY34 thanks to the new MAX 10 order. Our unit costs advantage over everybody else is supreme. We come into COVID with the lowest costs of any airline in Europe. We come out in an even stronger position, and the gap between ourselves on unit costs ex-fuel is widening, and we expect this to continue to be the case for many years to come thanks to the competitive aircraft orders and the other deals that we've put in place. On the quarter itself, we saw an 11% increase in traffic to 50.4 million passengers at a very healthy 95% load factor. Revenues were up 40% to 3.65 billion. This was helped by, as Michael said in his introduction, a very strong Easter, the extra bank holiday in the UK due to the coronation, and of course weak comps in the prior year Q1 due to the invasion of Ukraine. Operating costs increased by 23%, driven by a 30% increase in fuel, the annualisation of pay restoration, an investment in crew resilience this summer with higher crewing ratios, and impacted by the Boeing delivery delays. But we're very pleased to announce a 663 million profit this morning, and indeed strong growth in our earnings per share. On the balance sheet, the industry-leading balance sheet at this point in time, we saw gross cash of just over 4.8 billion, and that was despite the fact that we paid an 850 million bond last March and with 1 billion capex in the quarter just ended. We saw our net cash increase to just under a billion from 600 million at the end of the prior year in March. And we now have nearly all of our 737s unencumbered, and this enabled Fitch and S&P to upgrade our ratings during the quarter to BBB plus, something which I think was long overdue. And with that, Michael, I'll ask you maybe to run through current developments, please.
Okay, thanks, Neil. So for current quarter, we see robust summer 23 demand, certainly in terms of volumes. However, Q2 fares will be more modestly ahead of the prior year Q2 comp. And the prior year 2Q comp was very strong because of the impact of the Ukraine invasion on Q1. A number of challenges remain. Industry continues to be bedeviled by ATC strikes and woeful underperformance by European ATCs. We're seeing continuously now 15 to 20% of our flights on a daily basis being delayed by ATC capacity, which is basically understaffing essentially across Europe. It is unacceptable, and the European Commission should be taking steps to improve this shambolic service. We are facing higher fuel costs this year. Consumer inflation is running at high levels around Europe, and also interest rates are rising. So we're a bit concerned that they will put might dent consumer confidence or consumer spending, particularly as we move to the second half of the year, where we have almost no visibility at the moment. That's strong. Summer 23, we're building operational resilience. We have materially increased our crewing ratios in the expectation this summer would be difficult and ATC service would be poor. We've doubled up our ops control capacity here in Dublin and also at our centre in Warsaw. So we have materially more ops capacity and crewing capacity than we need to run the summer schedule, but that will be reflected in slightly higher operating costs for the half year. FY full year traffic will be at about 183.5 million, down from 185 million due to Boeing delivery delays. We are still recording some very significant market share gains across most EU markets, and we're very excited by our new market, our entry into Albania in the winter of 2023, where we will provide competition, choice, and significantly lower fares than the incumbent carrier. We're excited by the new 300 Boeing MAX 10 aircraft order that gives a path, a decade of growth out to 2034 in a market in Europe that is capacity constrained, is consolidating, and where very few other airlines are able to grow. And we're very proud of the fact that last week we published our 2023 Aviation with Purpose Sustainability Report, setting out are building on the very ambitious targets we have to make flying more sustainable in Ryanair between now and 2030. Touch briefly on summer 23. So we're operating at about 125% of our pre-COVID capacity, 124 game changers in the fleet by the 1st of August, which will mean significantly more efficient, fuel-efficient operations. Short-haul intra-EU capacity is running at about 93% of pre-COVID, according to Eurocontrol. That's translating into robust demand, strong, also helped by strong US and Asian inbound traffic flows, strong Q1 fares, Q2 up but tougher prior year Q2 comps, and we are operating, as Neil said, a record summer 23 schedule, about 3,200 daily flights, and we're hitting upwards of 600,000 passengers a day. That is reflected, these are the Eurocontrol figures, showing Ryanair by far and away the fastest growing airline in Europe. In fact, one of the very few growing airlines in Europe. We're up 25% on a much higher base of traffic, significantly stronger growth than any other airline in Europe. But challenges remain. ATC strikes. We've had 60 of them since the 1st of January. We submitted, as I said, a 1.1 million, our customer petition signed by 1 million of our customers. We're heavily investing in improved resilience in summer 2023, but we need action from the European Commission and from Ursula von der Leyen. It's no good talking about doing something for the single market or passengers. We need action, and that action should be to reflect in European-wide legislation the same protections that the Spanish, the Italians, the Greeks already do during ATC strikes. They protect overflights. Europe should insist that France does likely. There remain significant H2 uncertainties, ATC strikes, higher oil prices, inflation and higher interest rates, but we believe Ryanair is best positioned to thrive in this more difficult and challenging environment in the second half of the year. We've set out there very strong market share gains across almost all markets where we're now number one or number two, and the fleet growth with the benefit of the MAX 10 orders sees us embark on a decade of both fleet and traffic growth that will take us, we believe, from 183 million passengers this year to about 300 million passengers annually by 2034. Neil, you want to take the ESG update?
I will, Michael, and as you said, we're very proud of the fact that we're now launching our 2023 Aviation with Purpose Sustainability Report this morning. Thanks to the 300 aircraft order, we've been able to set even more ambitious targets for ourselves in relation to ESG. We've now set a target of 50 grams of CO2 per passenger kilometre by 2031, which you'll remember is well down on the 60 grams that we'd set for 2030. We've also now set out our transition plan to 1.5 degrees climate transition, which I think is a very important initiative. We continue to invest very heavily in new technology aircraft, which reduce our fuel burn. We're rolling out the Scimitar winglets on our NGs, which reduce fuel by 1.5%. And we're very pleased at the fact that we've now increased our partnerships in relation to sustainable aviation fuel, where we signed an MOU with Repsol in the quarter, which locks in SAF availability, our Spanish operations. So we've now got approximately 9.5% of the 12.5% target that we've set for ourselves for 2030 available to us. So making great strides in relation to ESG. Michael, do you want to run through the outlook?
Okay, so in terms of outlook, as I said earlier, we have slightly scaled back our traffic projections from 185 million to 183.5 million. We are seeing strong summer 23 demand, strong traffic demand, but Q2 fares will be much more modestly ahead of what was a very strong prior year Q2 comps. The Q2 outcome will fundamentally depend on what the strength of close-in bookings during August and September, and we've seen a softening in terms of yields of the close-in bookings during June and July to date. We've no visibility on H2. We have tougher prior year comps for H2, and also we're concerned about the impact of these macroeconomic trends. Consumer price inflation, higher interest rates, higher mortgage rates might affect consumer spending in the second half of the year. It is far too early for any accurate profit after tax guidance. We continue to expect modest growth over last year's PAT, but we can't put a number on it. The new Boeing MAX order means we're entering into a very exciting decade of growth for Ryanair in Europe, in a market where the market is consolidating, where capacity remains constrained and will remain constrained for the next 4 or 5 years. It means Ryanair is going to grow in new markets. We visited Ukraine last week, and we have discussed exciting plans with the Ukraine government to rapidly grow our traffic, restore traffic and tourism in Ukraine after the war ends. But that Boeing order, that MAX 10 order, will not alone widen the cost gap over all of our competitors, but sustain that growth to 300 million passengers. And so the Ryanair Group will, I believe, continue to deliver financial strength, a significant unit cost advantage over all other airlines in Europe, allowing us to deliver sustainable growth with more environmentally efficient aircraft in a profitable manner that will allow us to continue to reward our people, our passengers and our shareholders. Ryanair is and will, we believe, continue to be the long-term winner in European aviation.